This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In our introduction to CGT in Chapter 12, we saw how to calculate, first of all, the chargeable gain or allowable loss that would arise on any chargeable disposal made by a chargeable person of a chargeable asset. And in essence, the gain or loss was a very simple calculation. We would establish the net proceeds, sales proceeds less any selling expenses, deduct from that any and all allowable costs, both those that were incurred obviously when the asset was first acquired, but also then any further enhancement expenditure that may be incurred at a later point in time, something there to improve that asset. Now, having got either gains or losses, then for our tax year, consistent with income tax, we produce a Cgt computation for a tax year, 6th of April to 5th of April. And for that tax year, we would then net out the gains and losses of the year. Having got those net gains, we then look to see whether any capital losses brought forward. Clearly, in an exam question, a figure that would be given to you. We could then deduct those losses brought forward. Thankfully, though, with those, we got a rather better use than with the losses of the year. When you have losses of the year, then you must net out the gains and loss of the year, however big or small the gain may be, whether the use of that loss is of any use to you at all, whether it would actually simply reduce a gain that would be covered by our annual exempt amount, our AEA, or not, you must deduct gains and losses. So there's absolutely no point having a gain of 10 and then crystallising a loss of, say, £6,000, because a gain of 10 is less than the AEA, and the loss, therefore, would simply reduce a gain that wasn't going to be taxed, 10,000, down to a net gain of 4,000. So no benefit would be derived. But when we bring a loss forward, of course, that's very different. Then we only reduce any net gains of the year by the amount of the loss brought forward that will bring down those gains to the figure of the AEA, i.e. for us, £11,300, at least as it is for the 17-18 tax year. Okay. In calculating those gains, we saw that one of the potential problems that would make that very basic calculation more interesting, shall we say there, was determining the allowable cost. And so it is now in Chapter 13 that we see that problem to an extreme level. We're dealing, as you can see here, with shares and securities to be precise. And to begin with, we've got something that we saw actually at the very beginning of our studies of CGT. When we looked at a definition of a chargeable asset, we delighted in the fact that it was defined as all assets are chargeable unless they're specifically exempt. And of course, on that list of exempt assets, we saw these: gilt-edged securities, i.e. government securities, and qualifying corporate bonds, basic corporate loan stock. Any such disposals of those are exempt. Again, the sort of thing that it's easy to be seen and to introduce by the examiner to an objective testing question to determine which of these are taxable or which of these are not taxable, as the case may be, and a list of the various items. Those guys are exempt. But what this chapter is really all about, the disposal of shares. Now, when you sell shares, then of course you would know what you've sold them for. Even if we gave shares away, we'd be either given or be able to compute with a basic rule what the market value of those shares would be, as we again saw in the previous chapter. What our problem is cost. Now you might think, why is it a cost? I know what I bought those shares for. Well, yes, if you had only ever bought on one point in time, one acquisition, you knew how many shares and what the cost of those shares was, then dealing with the disposal of some or all of those shares wouldn't be a problem, because you'd know what the cost was. But what we see in reality, and what you will see in the exam, is of course it wasn't just one acquisition. That we built up a shareholding in a particular company over what may be a very extended period of time. We bought a few thousand here, a few more thousand there. I bought some shares 20 years ago in this company, 15 years ago, 10 years ago, 5 years ago, 6 months ago. In which case, therefore, when I sell some, but not all of those shares, which ones am I selling? if I do not know which ones they are, they having all been acquired at different costs at different points in time, how can I calculate the gain? So I need some way of recognizing when a share sale takes place, or even a gift of those shares take place, which shares are now being disposed of. Now, as you might guess, HMRC do not leave it up to us to decide which shares they will be. What's going to happen here is that HMRC dictate these are the rules by which we will identify on any share disposal which shares are being disposed of. And we have rules here that we're now about to see that are relevant for individuals. And in a later chapter, when we deal with the taxation of chargeable gains for companies within the corporate tax rules, guess what? There'll be a different set of rules. Wouldn't be taxed without another silly rule now, would it there? So in which case, what are these rules? So here in section 1.2, disposal of shares. As we've just said, our problem is determining the allowable cost, as we've acquired, as we said, over several acquisitions and at different costs at different dates. Therefore, we have the rules by which we will match a disposal with the particular shares now deemed to be disposed of. So what are the rules that you need to learn? Here they are. First of all, probably the least likely of all of the three rules that we need to know here that would be tested, but shares acquired on the same day. The same day, of course, as the sale. We've sold X thousand shares. Which ones are they? If we did acquire any shares on the same day, it is those. And we simply match the proceeds for that number of shares with the cost of those shares. Probably not that likely. More likely is this one. And it may seem a very strange rule that actually the next category of shares that we're deemed to have sold on that particular date of disposal is shares that the taxpayer doesn't even own at that point in time. But they are shares that the taxpayer goes on to acquire within the 30 days following the sale. Now that one is one that gets tested. Now, given again that we've got so much objective testing question and a section A there that is random questions, objective testing questions across the syllabus, this area is an ideal area in terms of such a question, whereby calculate the gain on this disposal, and we know how many shares were sold, at what sales proceeds, and then there's a list of acquisitions. And from that list of acquisitions, we need to organise into these three categories. As we have seen there, if there were any shares on the same day, they would be the first to go. Again, the least likely. This one, way more likely. Shares acquired within the 30 days following the sale. Now, again, you might say, what's all this about? Again, you don't have to know the backdrop to it, but until that rule came in, you would, as you would ordinarily think, look at, firstly, shares acquired on the same day, and then you go back to look at, well, what shares have I bought prior to this sale date? Now, what that would mean is that what a taxpayer could do would be to, any tax year, if they had a portfolio of shares and had not made as yet, as we get towards the end of the tax year, any gains, then if you don't make gains in your year, you lose the AEA. So what they could do is, with a particular shareholding, if, for example, the value of these quoted shares had gone up by, say, £11,300, not a number I take at random, then what you could do is at the end of one day of trading in those shares, sell them off, crystallise a gain of 11,300. Why are we happy to do that? In order to utilise the AEA. An AEA that if we do not use it, we would lose it there. And what does that do? Well, we've now disposed of the shares and we've crystallised a gain. But maybe this you think is a good investment and you'd like to keep those shares into the future. So what we do is sell at the end of one day, and at the start of trading the next day, we buy them back again. They're a quoted share. There will be a ready-made market, and that overnight the prices wouldn't really change. unless something very dramatic were to occur there. So what taxpayers were doing, we have a lovely expression for this, taxpayers were bed and breakfasting their shares. They would sell at the end of one day crystallised gains to cover the AEA, buy them back again the next day. There would be some transactional costs, but what it would have succeeded in doing is to increase the base cost of those shares by £11,300. That means that the next year, when they go up another £10,000, I do the same again. I sell and buy back. I crystallise gains covered by AEA. Better that than keeping that particular shareholding in that company for, say, 5 years, and then ending up in one foul swoop selling all of those shares 5 years later and making a gain of £50,000. Now that's very nice, of course, a gain of £50,000. But it all falling in 1 year will mean one AEA to go against that total gain, and that would therefore leave the rest of it, most of it, fully taxable. Again, going through your basic rate band, if there is any, but probably more likely up into higher rate. So better, therefore, to crystallise gains little bit by little bit over the period of ownership. Sell at the end of one day, buy back at the other. Now that at the time was a perfectly good tool that taxpayers would take advantage of. Sensible planning. Utilise your AEA. And as you might guess, it's something where HMRC said, that's rather clever, isn't it, what they're doing here? We'd better stop that. So what they did, therefore, was to say, we've always had that rule, the shares acquired on the same day, but then the shares acquired within the 30 days following the sale. So if you sold at the end of one day and bought the next day, you will relate that share sale to the next day's acquisition. They didn't just stop with the next day, they put it a period of 30 days. Now, of course, you could still bed and breakfast. You'd have to stay in bed for over 30 days there. And of course, in that period, the share prices could change quite dramatically. So it was a way of stopping us as taxpayers basically cashing in a very easy way, our AEA, on what was an easily marketable security, a quoted share. Now, you don't have to worry about the background to that. What you do have to worry about is knowing what that rule is. But then most of your time in relation to dealing with the share disposal is going to be with this. Because most of the shares that you will be selling at any point in time will not be shares you acquired on the same day, will not be shares you acquired within the following 30 days. They're going to be shares that you bought prior to this disposal. And those go into a share pool. The rule is a share pool. That's better. So in which case, what does this share pool look like? And all it is a listing exercise. Very simple in CGT for individuals. The share pool is a bit more interesting when we come to look at corporate tax. But for individuals, it's ever so easy. You are going to run 2 columns, recording in those columns, first of all, the number of shares at any point of acquisition that you acquire, and the number of shares at any point of disposal that you dispose of, whether you sell, whether you give away. And for each of the shares acquired, the points of acquisition, the purchases of shares, you will record the cost of shares. And when you come to a disposal, if of course I sell off 40% of the shares within that share pool, then I will take out with those shares 40% of the share cost on that pool. Effectively, I'm not looking at those acquisitions on an individual basis. What I'm doing is to take them out of the pool on an average cost basis. The pool forms an average cost at any point in time for the total number of shares in it and the total cost incurred in acquiring those shares. So we're going to use that average cost basis to then determine any gain arising on the disposal. So the number of shares will include all acquisitions, including, and there we go now, from your accounting knowledge, we should know about those two, a bonus issue and a rights issue. Bonus issue, we might not see much sense in. A rights issue is rather more sensible. But what are they? Bonus issues are where a company issues free shares on a proportionate basis to its existing shareholders. Bit of a waste of time, you might say there. All it's doing is to organise the capital section of it, or dare I use an old-fashioned word term here, the balance sheet there. It's reorganising its, again, capital section of its balance sheet. The more relevant one, I suppose, in terms of why would you do this, is a rights issue. Here, rights issue is where a company seeks to raise new share capital. Yeah, if the company is going to issue new shares, you think the main reason for doing it is they're looking to raise new share capital. They may be becoming acquisitive, go out and buying shares in other companies. They may be looking to replace a whole lot of plant and machinery, invest in property, land and buildings there, research and development, whatever. Variety of reasons. And on that basis, they may look to raise new share capital. Now, who would you go to first in terms of raising that share capital? Why would it be anything other than your existing shareholders? They thought it a good idea to buy shares in this company in the first place. So let's go to those existing shareholders first and offer them a deal. Here we go, guys. For every, that can be whatever terms you wish, but say, for every 4 shares you own in the company, you can acquire 1 more share, a 1-for-4 rights issue, at this particular price. A price, of course, that would be somewhat discounted from the current market price of those shares. What a good deal that is. It's then down, of course, to the individual shareholder to decide, do they want to part with any more money and acquire those additional shares. So, raising new share capital offers its existing shareholders the rights to acquire on a proportionate basis, additional shares there, like 1 for every 4 shares held in the company at an advantageous share price. Now, having accumulated through a series of clearly what must have been an original acquisition or acquisitions, then either a bonus issue and or a rights issue, we come, of course, to what you're going to have to deal with in your exam question, a disposal. And when that disposal occurs, we will know how many shares have been sold and how much they have been sold for. What we've got to do to calculate any gain is to work out cost. But that's going to involve potentially 3 or probably here 2 separate calculations of gains. Again, the first order of ID, shares acquired on the same day. Probably wasn't any. The shares acquired within the 30 days following the sale. So there we're specifically saying that 1,000, 2,000, however many shares bought, 10 days, 20 days after this disposal, they are now the first that we deem to have been sold. All of the remaining shares come from the pool. So you do one calculation of a gain for those shares acquired in the following 30 days. What is their sale proceeds? What is their gain? And then a separate gains calculation for the shares that come from the share pool. What is their sale proceeds? What is their cost? A cost that we've established from the share pool, where we've listed at each point of acquisition, number of shares and cost. And maybe at this point of disposal, we have got 50,000 shares that now have a total overall cost of £300,000. And if I sell half of those shares that have a total cost of 300, I take half that cost of 300 with those shares. So it's a proportionate, it's an average cost basis that we use. So let's have a little look, therefore, at how we do this. Again, there, the shares disposed of from the share pool will be deemed disposed at an average cost of the shares held within that pool. As we have mentioned there, this is an easier calculation than that which attaches to corporate tax, but that awaits us, as I say, in a later chapter, because something that we did very briefly mention in our introduction to Chapter 12 on CGT is that for you or I as individuals, the gains calculation was very simple. What did I sell the asset for, less what was the cost of that asset? That was it in essence. There was no relief for the effect of inflation, the time value of money. Well, when we look at corporate tax, companies do get relief for the effects of inflation, but as I say, that awaits us in a later chapter. Let's have a look then at this example. Again, our requirement to compute James' capital gain on the disposal of the shares on the 28th of February 17. Now look very carefully at that disposal date, because we're going to have to check out firstly, did we buy any shares on the 28th of February 17 there? Did we do that? Or indeed, did we actually buy shares within the following 30 days? Or did we indeed then just have shares acquired before that particular date? That's the basis that we've now got to work on here. Okay. So in relation to this, have a little read through the question there, if you'd be so kind. And then we'll see how to tackle it.